Welcome to Iron Financial, the shop where we forge stronger portfolios by putting the market's biggest movers through a serious stress test. Today, Elbit Systems is in the crucible. Now, the stock absolutely took off, just rocketed higher after dropping what the street is calling a monster quarter, a total blowout. But you know us, we don't trade on headlines. Our job is to get under the hood, pop the latch, and inspect the wiring ourselves. We're here to figure out if Elbit has really built a financial fortress made of steel, or if the market just bought a first-class ticket on a hype train for what's actually a house of cards. Look, the crowd always chases momentum. We're here to inspect the foundation, brick by painstaking brick.
All right, let's get right into it. We are running a full-blown financial stress test today. First up, we're going to unpack the headline shockwave. That means looking at the exact numbers that sent the market into a frenzy. Then, we're going to inspect the main pillars of this whole structure, what we're calling the revenue and backlog fortress. After that, we are drilling into the profit engine to see if this thing is running clean or if it's just burning oil. And then comes the part I live for. We search for the cracks in the foundation, zeroing in on valuation, and of course, execution risk. And finally, we will deliver the iron verdict. Let's get to work.
So, Section 1, the headline shockwave. This is the catalyst, right? This is the spark that lit the fuse on this rally. On the surface, the numbers looked absolutely fantastic, and before we can start picking them apart, we need to understand exactly what Wall Street saw that made them slam the buy button so hard and so fast.
And there it is, right from the top. You couldn't write a more perfect statement if you tried. A CEO can't paint a better picture. I mean, every single key metric isn't just pointing up, it's showing massive acceleration. You got revenue, margins, earnings, backlog. It's a clean sweep, a grand slam. When a CEO comes out with a statement this confident and this comprehensive, it's a massive bullish signal. He is screaming to the market that the entire machine, from sales to operations to future orders, is just firing on all cylinders. This quote, right here, was the match.
Okay, and this is where we put some hard numbers to that confidence. See, Wall Street isn't really about good or bad, it's all about better or worse than expected. And Elbit didn't just step over the bar here, they pole vaulted over it. Full-year non-GAAP earnings per share hit $12.75. The final quarter beat estimates by a huge 42 cents. That's a big deal. Revenue clocked in just shy of $8 billion for the year. Look, these are not rounding errors. These are significant, powerful beats that force hedge funds and analysts to literally rip up their old models and recalculate a company's entire value. That is what creates a stock surge like the one we saw.
Okay, let's just pump the brakes for a second. Of course, the CEO statement sounds perfect. That's his job. That's why they pay him the big bucks. And a stock popping on an earnings beat? That's just another Tuesday on Wall Street. The real question for us, the important question, is about durability. Is this a business that has structurally shifted into a higher gear for the long haul, or are we just looking at a short-term sugar high from a world that's on edge? You know, excellent is a great headline, but is the underlying business really strong enough to justify the vertigo-inducing price investors are now being asked to pay? We have to separate the fundamental reality from all the geopolitical hype? And that's a fair point. That's exactly why we're moving past the headlines and onto the load-bearing walls of the company itself. We're going to inspect the two core pillars of this thing, its revenue generation and its absolutely massive order backlog. Forget the narrative for a minute. Let's just look at the cold, hard data that defines the scale of this industrial giant. This is where we find out if the fortress walls are actually made of granite or if it's just drywall.
Right, so the crucial point here isn't just the size of the number, it's the momentum behind it. We are talking about nearly $8 billion in annual revenue. That's big, but the real story is the velocity, a 16.3% increase year over year. For a company of this scale, that's not just growth, that is jaw-dropping acceleration. It tells you that global demand for what they sell isn't just steady, it's actually intensifying. This isn't some nimble little startup finding its footing. This is an established battleship finding a whole new gear of forward thrust. It's powerful stuff.
And this, right here, this is the foundation of all that growth, a $28.1 billion backlog. For anyone analyzing this company, this is arguably the single most important number you can look at. It's the bedrock. Think of it like this. It's guaranteed revenue, already signed, sealed, and contracted for the years to come. This gives the company and its investors incredible visibility into the future. It tells us that the $8 billion in revenue this year was not a fluke. They have over 3.5 years of their current revenue run rate already locked in and ready to go. A backlog this massive is a powerful shock absorber against any economic uncertainty. It is a literal wall of future cash flow.
Okay, now let's see how this whole thing is built.
This slide is critical because it breaks down where that 16% growth is actually coming from. And it's not a gentle, even lift across the board. Just look at the land segment, an absolutely explosive 38% jump. The earnings call made it crystal clear. This is being fueled by staggering demand for ammunition and land-based systems, mostly from Israel and from Europe. But it's not a one-trick pony. You can see iStar and C4I are both pulling their weight with very strong 16% growth. So multiple engines are firing, for sure. But the land division is the afterburner kicking the whole operation into overdrive.
Hold on a minute. That same chart, the one you're so excited about, it also reveals the first potential crack in the armor. Yeah, the big story is one of explosive growth. But the data shows a more complicated picture. Aerospace, it grew by just 2%. In a sector this hot, 2% isn't growth, it's stagnation. That is barely keeping up with inflation. So while the land division is out there breaking the sound barrier, the aerospace division can barely get off the tarmac. It tells you the strength isn't universal. And it forces us to ask a really tough question. Why is one of their core legacy segments, a huge part of their business, being left so far behind?
That's a fair challenge. A fortress is only as strong as every single one of its walls. So now, let's drill deeper. We've established the enormous scale of the revenue. The next logical question is it profitable revenue? Is this $8 billion machine running efficiently and actually converting those sales into real profit? Or is it just some bloated giant burning through cash just to get bigger? Let's pop the hood and check the engine's efficiency.
This is the hard evidence right here. Forget revenue, operating income is what really matters. And look at the land division again. It didn't just grow, it nearly doubled, jumping from about $150 million to over $263 million. That is an incredible display of operating leverage. Elbit Systems of America also more than doubled its contribution. This shows they aren't just selling more stuff, they are doing it far more profitably as they scale up. And to your point about the so-called weak link, aerospace, well, while its revenue is flat, look, its operating income actually ticked up. It's holding the line on profitability even without that top-line growth.
And it all flows right down to the bottom line. Earnings per share. The official GAAP number jumped a staggering 59%. But the number that Wall Street really zeroes in on is non-GAAP, which is supposed to show the core operational earnings power of the business. That figure was up a very strong 46% to $12.75 a share. That is powerful growth. But hang on. That word, non-GAAP, it always makes the hair on my arm stand up. It's a curated number. It means management is taking certain expenses out because they want you to ignore them. So the billion-dollar question is always the same. What are they hiding?
Exactly my point. Let's pop the hood on this so-called non-GAAP engine. The company's own report lays it all out for us. You've got amortization, capital gains, forex swings, and okay, that's all fairly standard accounting stuff. But let's focus on the last two items. Stock-based compensation. That is not some imaginary number. That is a real expense. It's how you pay your talent. Excluding it makes your earnings look artificially high. And even more telling is this line right here. Non-indemnified costs related to special circumstances in Israel. These are real-world cash costs of operating in a conflict zone. For 2025, that was $9 million. By just stripping those costs out, are they painting a picture of profitability that's just a little too clean compared to the messy reality on the ground?
Look, you can get tangled in the weeds of accounting debates forever. GAAP, non-GAAP, they're just different lenses to look through. At the end of the day, there is only one number that is pure, unvarnished truth, and that number is cash flow. And this right here is the ultimate rebuttal. Net cash from operating activities surged by nearly $244 million year over year, hitting almost $778 million. That is real money, hitting a real bank account. It proves that regardless of any accounting adjustments you want to argue about, the underlying business is a powerful, healthy, cash-generating machine. You cannot argue with cash. It's the bottom line.
Cash is king, I'll give you that. The engine is definitely running strong. But, you know, a Ferrari that you bought for the price of a private jet is still a bad deal. For this final section of our stress test, we have to look for cracks. Not in the operations, we've established those are solid, but in the investment thesis itself. We're going to examine the balance sheet, but more importantly, we have to talk about the price tag and the enormous risks that lie ahead. Let's see if this fortress is built on solid ground or on a cliff's edge.
Before we get to price, let's talk about the ground it's built on. And let me be clear, the foundation is rock solid. The balance sheet is a fortress. The Altman Z-score, which is basically a fancy formula for predicting bankruptcy, is at 3.97. Anything over 3 is considered the safe zone, which means the probability of financial distress here is extremely low. The debt-to-equity ratio is a mere 0.27.
This company is not burdened by debt at all. It has immense financial flexibility. And the current ratio shows they can easily cover all their short-term bills. From a pure financial health standpoint, this company is absolutely built to withstand a storm.
And I won't argue with you on that. The foundation is solid, the balance sheet is clean, but you are paying a king's ransom for that safety. This slide puts it in perfect contrast for you. Yes, the foundation is strong, but look at that price tag, a price-to-earnings ratio of over 90. To put that into perspective for you, the historical average for the entire aerospace and defense sector is typically somewhere in the 20 to 30 range. We are talking 3 to 4 times the industry norm. You're not just paying a premium here, you're paying a price that assumes decades of flawless execution and nonstop growth. It leaves zero, and I mean zero, margin for error.
And things can absolutely go wrong. You see that $28 billion backlog as a strength? I see it as a monumental execution risk. It's a gauntlet. If you look closer at the details in the report, you'll see this. 54% of that backlog, that's over $15 billion worth of product, is due in the next 24 months. They have to essentially double their production rate, and they have to do it while operating in the middle of ongoing geopolitical conflicts, which they explicitly reference in their own filings. They also admit they are dealing with supply chain disruptions and higher transport costs. So you have to deliver a historic amount of product under extreme pressure with a strained supply chain, all for a stock that is priced for absolute perfection. That's not a strength. That's a tightrope walk without a net.
All right, the stress test is complete. We've examined the headlines, we've inspected the revenue fortress, we've drilled into the profit engine, and we've searched for the cracks in the foundation. Now it's time to weigh the evidence. We have the clear bull case and the very compelling bear case, so what is the final iron verdict? Is Elbit Systems an opportunity to fortify your portfolio, or is it a valuation trap that's just waiting to spring?
Let's just summarize it one more time. The bull case, what we're calling the fortress view, it's built on hard, undeniable facts. You've got a record $28 billion backlog providing incredible revenue security. Growth is accelerating at over 16%. Profit margins are widening, which proves efficiency. And most importantly, this company is a cash flow machine. The operational momentum is very, very real. But the bear case, the facade, is equally grounded in reality. It's built on that sky-high valuation that seems completely disconnected from any historical norm. This premium price tag is pinned on them executing flawlessly, on delivering over half that massive backlog in just 2 short years. And all of this while being heavily dependent on a volatile geopolitical climate and with a major business segment, aerospace, showing basically zero growth.
So, here it is, our final verdict. Elbit Systems is a structurally sound fortress. The business is strong, the balance sheet is immaculate, and management is executing at a very high level. This is no house of cards. However, this fortress is being sold at a price fit for a king. The current stock price has baked in every single piece of good news and has completely ignored the very considerable execution and geopolitical risks that lie ahead. The market is paying for perfection in a deeply imperfect world. For us here at Iron Financial, that means there is no margin of safety. Therefore, our verdict is a hold, not a buy. It is an excellent company, but at this price, it's a precarious investment. The question you have to ask yourself is this: are you willing to pay for a fortress that's built on a cliff's edge?
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.